instead what we're going to do is Vince is going to do a brief summary of some of the economic topics he talked about at the seminar, and then we'll do a Q&A portion with attendees. So for all of our attendees, once Vince starts talking and we enter the Q&A portion, you can put your questions into the question chat area, and I will relay those over to Vince and he'll answer them for you. In addition, if you want to ask your question to Vince, I can unmute you and let you ask it directly to Vince. So we have two options. So Vince is the President and Chief Executive Officer with LaSalle Economics. And so Vince, if you want to introduce yourself further and provide some opening comments, we'll go ahead and kick it off.
Okay. Well, the introduction has been done. I've spoken many times to many different farm groups, and we always touch on the macroeconomy, the outlook for interest rates, and the outlook for agriculture. And this one will be no different. I'll probably make some remarks that I didn't make in my earlier speech, just to take into account more current economic information as it's flowed out in the past several months. I guess one of the things that we had suggested was that the S&P 500, which we use as the barometer for public opinion throughout the world, would go over 1,400 by summer. And since we've already done that, we'll declare victory, although given the kind of weather that we've had over the past 3 months, it's pretty hard to distinguish winter from summer from spring, at least this year. But at any rate, we termed 2012, we thought, would be sort of a year of paralysis for the global economy as it sort of absorbed all the shocks that took place over the past couple of years, whether it be the Arab Spring or the tsunami and earthquake in Japan or the European financial problems and the like. And while those were centered outside the United States, we highlighted a number of different upcoming events that would plague the United States in particular. And we sort of made a list of all the different things that could act as constraints on business decision making, whether it be the health care reform law, which is going to be debated by the Supreme Court next month, with a decision to be made this summer, or all the fiscal tax-related constraints, which I think we were probably the first ones to discuss late last year and early this year, but now it's sort of gaining flavor, and a lot of people are starting to write about it. And so I think attention is being focused on the fact that at the end of 2012, at least under current law, the U.S. economy is just going to be hit with a massive dose of tax increases, whether it be the expiration of the Bush-era tax cuts across the board, new taxes imposed as a result of the necessity of financing the new health care law, the Congressional Super Committee that was in charge of deficit reduction couldn't reach an agreement last November, so they punted, and automatic spending cuts go into effect in January of 2013. And now we also have, while we have a payroll tax extension to carry through 2012, that too is supposed to expire at the end of 2013. And basically, when you add all these things up, what it amounts to is over $500 billion of tax increases and spending cuts at the federal level that are supposed to take place in January of 2013. And that's about 3% of overall output as we measure by GDP. And the result of that is that if that is allowed to occur, the result of that is that the United States is going to be hit with another recession in the first part of next year, and it could be serious enough as to send the global economy back into a recession. Now, nobody knows whether all those tax increases are actually going to go into effect, whether some of them are going to go into effect, or whether none of them are going to go into effect. But the budget situation is in such dire straits that if they don't go into effect, the debt is going to balloon, and if they do go into effect, the debt may be reduced initially, but because it will send the economy into a tailspin, the debt would explode anyway. So I think the point of all of this is, number one, there's no easy way out of the kind of fiscal situation that we find ourselves in, at least in the short run. Number two, we really don't know what the law is going to be come January of 2013, and I dare say probably it's going to be largely determined by the outcome of the election. And number three, that as a result of that, we sort of felt that business in general and consumers and individuals in general would have a hard time making decisions and would pretty much be paralyzed as we go through 2012. Now, when I say paralysis, that doesn't mean that the economy itself is going to be paralyzed. Rather, we kind of thought that it would sort of mumble and stumble along in the kind of real, low growth mode that has characterized this overall economic recovery anyway. And I think on balance, as we look over the last 3 or 4 months, that's largely been true, although we have had sort of a burst of enthusiasm here because certain segments of the market, certain segments of the economy have looked better than expected. For example, housing, and there has been some better performance by the labor market over the past couple of months. The only problem with that is that it's hard to discern how much of that is real and how much of that is artificial. And by artificial, I mean that it certainly appears that a certain amount of economic activity has been borrowed from the future. If you think back to last year at this time, about 98% of the country was covered with snow, and it was a cold winter, whereas this year, not only hasn't there been any snow, but it's been mild. And so a lot of economic activity, which would normally not occur in the first part of the year, has been able to occur this year. And the question now is whether that activity is going to provide some momentum to the economy or whether it's simply borrowing from the spring and the summer, in which case then the economy will start to look a little bit more dull as we go through the spring and summer. Questions will start to arise as to whether we're running out of gas. That will bring the Federal Reserve back into play with the possibility of more easing by the monetary authority. And at the same time, with the stock market having run up as much as it has, it wouldn't be surprising to see some sort of correction develop in the stock market as we go through the spring and summer. So that in summary is sort of how we viewed the macro economy. As far as the agricultural economy is concerned, we've been pretty much concerned not only by the prospect of continued slow growth in the United States, but also a continuation of sluggish activity in the rest of the world, particularly in Europe, which has really gone through the ringer in the last year, and more recently in Asia, where economic growth has clearly slowed down. And now the big question is whether China will have sort of a hard landing or a soft landing, and whether that'll reverberate throughout the entire world. The good news to all of that is that monetary authorities are keeping their feet on the accelerator, and so interest rates are staying low, and the world is flush with liquidity. But the bad news of all of that is that some of these problems are so structural in nature that they may be unavoidable anyway. Given the slowdown in the rest of the world, our feeling had been that the dollar would look like about the best currency amongst the bad lot in 2012, so that the dollar exchange rate would be supported. And we thought that, coupled with some developing weakness in exports, might have a negative impact on agricultural commodity prices. Given what we've seen over the past 3 months, if anything, we feel even more strongly about that, for the simple reason that it sure looks like, given the kind of weather that we've been having, there's going to be an early plant this year. I think there's going to be fence row to fence row planting. And so the thing is that if we get normal weather this summer and adequate moisture, I think we're going to be tripping over the grain in the streets of Iowa and in the gymnasiums because there's going to be so much there. And I think all of that will put downward pressure on grain prices, agricultural prices. And our big concern, of course, has been that with our farmland prices having gone up so much in value over the past several years, that with developing weakness and trend-like weakness in agricultural commodity prices, we might see a significant correction in farmland values, particularly when we look at farmland values as an asset relative to other assets which have performed poorly. We might start to see a flow of funds away from agriculture and into other areas, whether it be equities or other things. And so we raised that as a concern. It's something that one should be watchful for, and we just have to see how it all develops. So in a nutshell, that's pretty much what we talked about, and I'd be happy to take any questions.
Great. All right. Well, attendees can plug in the questions into the comment question box and kick a few questions off. I guess as a first question is that the dollar has been weak in comparison to the other monetary across the globe, and I was wondering, what will it take to increase the strength of the dollar again?
Well, in the last year, the dollar has regained some momentum. You know, it's sort of been a race to the bottom with all these different currencies, and that almost every country wants a weak currency because they'd like to promote their own exports, and they feel that a weak currency will give them an edge in export markets. So I think that's one thing, and that's one of the reasons why gold has sort of been a standout asset in recent years. But what it would really take to give us a trend line recovery in the dollar would be evidence of economic stability in the United States, such that the Federal Reserve could start to back away from the liquidity injections that it's been doing over the past 2 or 3 years. And so I think if we got government-sponsored policies, if we got government pro-growth policies in the way of taxation and regulation, and we cleared up some of the uncertainty that's on the docket for early 2013, I think that would create more certainty, and that would start to put a real solid floor under the dollar exchange rate.
Great. All right. Well, another question we have is that the emerging economies have kind of been front and center over the last 5-10 years. A lot of rumors about how, you know, China's growing at exponential rates, Brazil, India, other countries like that. With the stress we've seen on the global economy, can these emerging countries stay on a pathward up, or are they falling back like we've seen with Europe and the U.S.?
Yeah, I think the emerging economies are still relatively strong performers, probably not as strong as they have been. However, I think as we look out over the next 5 to 10 years, I think my personal view is there's reason to be less optimistic about the performance of the emerging economies relative to the United States. And I'll just cite a couple of things. If we look at what's happening in China, for example, it's clear that wages are on the rise throughout all these emerging economies, particularly in China. And if we look at what's happened to labor costs in developed economies, particularly the United States, there's been very little wage growth over the past 3 or 4 years. We're almost at the point now when we compare labor costs in China and other emerging economies with labor costs in the United States. The United States is looking a lot more competitive than it has. That's number one. Number two, I think one of the side effects of the Japanese earthquake last year and tsunami was that it caused a lot of supply chain difficulties. You know, it broke the inventory string. And I think as a result of that, it's at the margin giving some companies the incentive to keep inventory back near their home markets, which means more production at home as opposed to around the globe. And number three, I think we have to think about the cost of energy now. When we see what's going on in the United States in terms of, I don't want to call it an energy revolution, but when we see the huge increase in domestic energy production that's taking place in the United States, and particularly the low price of natural gas, which is used as a power source for many productive facilities, when you put all of those things into an equation and wrap it up, you can certainly make a much stronger argument now that the United States is becoming increasingly competitive in the production process on a global basis. And so what I'm kind of thinking is that with these forces in place, if we can get the right kind of tax and regulatory policies to encourage business, I think we could see a significant flow of production back to the United States. And if that's the case, then the emerging market economies are not going to grow as rapidly as they have in the past. The U.S. economy is going to grow more rapidly than it has in the past. And on a relative basis, we're going to be looking a lot better.
Great. Another question we have is, especially in January during your presentation, you touched on volatility and what's ahead for agriculture. So now that we're almost into planting season, is volatility still going to be the word everyone uses to describe agriculture and farming the rest of the year?
Well, you know, as we look back to 2011, we used volatility almost to describe everything. And actually things have become quite a bit less volatile in 2012. And my feeling had been when we spoke back in January, February, that volatility would tend to die down a bit. And it clearly has been dying down. And I don't expect there to be nearly as much volatility as there was over the past couple of years, which I think is good. It's good from a planning standpoint and the like. And I think even with respect to agriculture, well, the weather can always give us jitters and that sort of thing. I think if I'm right and that we get normal weather and we have the kind of production increase that I think is possible, I think it would be more of a trending type market than it would be a highly volatile market.
Great. All right. Well, we have a question that concerns some policy issues. With the huge deficit that our government has right now, where do you expect to see cuts in agriculture in trying to solve some of that deficit issue?
Well, I wouldn't pretend to be an expert on that. I think the only thing I would say with respect to that is that I think there's going to be shared sacrifice. I don't see any way out of this with some sectors being sheltered and other sectors not. I think agricultural programs are going to have to bear some of the burden of spending cuts and the like. I think a lot of this, of course, is going to depend on the outcome of the elections in November, not only with respect to the presidency, but with respect to the shape of the Congress. And I think what we need to do is not so much worry about whose axe is going to be gored, but just hope that there can be some sort of consensus formed so that responsible policies can be undertaken to get us out of this mess.
All right. Well, just a reminder for our attendees, plug any last questions you have in for Vince. So another one is that farmers have been very lucky in the last few years to see high profits, record profits. So what could be looming on the horizon that could kind of crash these good times that we've been seeing in agriculture?
Well, I think two things. Number one, I think if I'm right, and I don't think this would crash the good times in agriculture, but if we move into a period of surplus production, clearly prices are going to go lower, and clearly incomes are going to be hurt. At least cash flows are going to be hurt. And if you wanted a double whammy, then we would, you suppose we had a real spike in energy prices. as a result of the hostilities taking place in the Middle East, or the potential hostilities taking place in the Middle East. I think that's one externality that we hadn't touched on, but something that's clearly there and something that we have to worry about. I think that's number one. Number two, I think the thing that you have to worry about is, you know, trees don't grow to the sky. And when you look at how much appreciation you've seen in land values over the past 5 or 6 years, you know, you have to look at farmland, even though a farmer doesn't tend to look at it this way, but you have to look at farmland as an asset within a basket of assets, and you have to look at the outperformance of one asset class versus the underperformance of other asset classes. And you might start to see at the margin a shift, particularly among the non-farm community, to get out of agriculture and into other depressed assets. And that's the kind of thing that could cause prices to start to weaken at the margin and then accumulate from there. So I would be careful about that, and I think that's something that, you know, something that's really difficult to see until it happens. But at these levels, I would tend to be cautious.
Right. All right. Well, we have one final question. With the wonderful and mild weather that we've been seeing in much of the Midwest, and with the upcoming big USDA reports on March 30th, what is your short-term prediction for grain prices this season?
Lower.
Good answer. Do you want to expand on why?
Well, I think we're going, you know, I think there's not going to be any problem. You know, we had floods at this time for the last 2 or 3 years in various areas of the Midwest. This year, it looks like we have ideal weather conditions for planting. So we have ideal weather conditions for planting, and that's going, when you see how much is in the ground and how much is in what kind of shape, I think that's going to be the first negative sign for prices. And then it's a question of what kind of weather we get this summer. If we get good weather this summer and adequate moisture, we're going to grow like crazy. And I think we're going to go from scarcity to surplus, and that's going to drive prices lower. I'm still sticking to my notion that corn will go below $5 a bushel.
All right. Well, Vince, you've provided some great insight and some really valuable advice for the farmers that we've had attending with us. So thank you very much for providing all of that insight.
Okay, great. Thank you for having me.
All right. With that, that concludes this webinar. So thanks, everyone.
Thank you.